Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Ice raw sugar in New York. The main pattern here since September 2024, so for well over a year and close to a year and a half, has been, though I'm not now starting to look at another pattern, has been, despite being breached and repaired, the dark blue September to December 2024 bear channel, which is currently 974 to 1464, that developed into a descending expanding wedge pattern. We're at this time outside and just on top of the dark blue upper trend line, and have been since late December last year. But the market will still not let go of this pattern, though I suspect we are coming to an end. The mauve medium moving average, currently at 1528 in recent times, has acted as a dynamic cap on prices, whilst the green short medium moving average, currently at 14 3/4, is acting more as a support nowadays after earlier being a capping resistance. There are two other patterns that have greatly influenced this market. The first, and the one that I think may be trying to take over as the main pattern here, is the bright green late September 24 to late February 25 bearish shift pitchfork. I drew the original bearish Andrews pitchfork for this move some 42 weeks ago, as it seemed back then to be a better contender in showing the bearish angle of attack, but that did not last, and I finessed it to the shallower bearish shift pitchfork for the same move. Today we are just above the bright green middle time, which is currently at 1465. The second pattern is another larger bearish pattern, which I'd also previously spoken about, and a good contender even now in showing the bearish angle of attack. It is the longer term bright red November 23 to September 24, similarly but slightly shallower bearish shift pitchfork. On this one we're a little above the bright red middle time, which is currently at 1393. We also have, seem to have had for months now, the March 2021 low. They're in there at 1466. I don't know whether it's actually being more of a nuisance than anything else, or support or resistance. Further below we have, as I said 11 weeks ago, and I quote, "We next have support on the downside on congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches, this congestion stretches from 1409 down to 1379. All that is needed is for this to be tested. For these to be tested is stabilization under the bright red middle time," end of quote. Well, we had that stabilization between late October and early November, and nothing much happened. So the market started to move back up over the bright red middle time, but was constrained in its height by initially the bright green middle time and then the mauve medium moving average. Below this support between 1379 to 1409, well, we really don't have that much support until around the 1248 level, and I'm not too confident about this supposed support down there as well. We also have a gap between 1336 down to 1320, dating from September 2020, so a lot has depended on that congestion support between 1379 to 1409. Top of all that, October was a monthly key reversal down, a bearish factor, though as I said 11 weeks ago, and I quote, "I can't help thinking that maybe such a pattern could be seen as a swan song. However, until otherwise the pressure is still on the downside," end of quote. Well, even now the pressure is still on the downside, though we seem to have undergone a small mild halt in the decline right now. Ice Europe white sugar in London. After all this time, there continues to be three features of this market to keep bearing in mind on this daily chart. First of the three features is the obvious broken, repaired, broken again, repaired, and lately broken purple late September 24 to mid-February 25 descending expanding wedge pattern, which is currently 415.90 to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary made back in January 2025, and had earlier been severely tested on the top side, enough that I would not necessarily classify as a descending wedge pattern after February 2025, though I continue to still keep an eye on the extension to the purple upper trend line. As it is, bar some congestion at 425.5, the nearest support stroke resistance of this market, the one caveat to this trend line is how it was broken on the upside 7 weeks ago, but even now the market still has not untangled itself from its vicinity. Next, I also asked you 37 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitch walk. This is a very shallow pitch walk. The more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market initially started utilizing the bright pink middle time of this bearish shift pitch walk, which is currently at 446.5, as an attractor, riding prices lower in a shallow glide until early October, when it started a further, steeper journey lower, such that in early November, the market, that's last year, the market had been closer to the pink lower trend line, lower time. It's currently at 388.10. However, we have seen a pull upwards since mid-November, though it is now using the congestion at 425.5 as a seeming attractor. So we are in between the two bearish pink tines. The third feature, which developed since the beginning of September and late 11 weeks ago saw prices break above it, is the red early September to late November bear channel. This bear channel had been excellent at showing during the summer and into autumn 2025 the bearishness of the market, including 11 weeks ago the lowest low since December 2020. However, that same week prices broke above and out of the bright red bear channel, and late 8 weeks ago stabilized over it. Now, as a result, 7 weeks ago I laid out possible targets for this break higher, of a primary target X up in the 447.40 area, and a secondary harder to achieve target X1 up in the 454 even area. I was not too sure about these two targets, as in the past the green short medium moving average, currently at 423.10, had been very effective in batting prices back down, but for now they still stand. Now, one final feature to note, and it's how the mauve medium moving average, currently at 442.5, which had tracked along parallel to the bright pink middle time since last year, has started dipping below it. Now, this has happened before, but it's worth pointing out nevertheless, as I think it will become relevant in the coming weeks, as the market and the medium moving average continue to approach each other. Sugar white premium spread. This one has been a very disappointing one, not because of the market doing the opposite what I thought the patterns might indicate, but because the market has instead done nothing, or at least nothing much. 17 weeks ago I said here, and I quote, "Things seem to be trying to resolve themselves into a pattern," end of quote. And over the intervening weeks, they seem to be doing just that, though not always the way I imagined they would, or even into a clear resolution. You see, I thought it might be moving towards, as I cautioned for a number of months, and again I quote, "I have a fear, and it is a real fear, that the whole February 25 today action may be trying to form a possible diamond pattern," end of quote. Now I continued, and I once again quote, "This would be a large pattern in time, probably from February through to November this year," so that's 2025, "and in height roughly between just under 100 up to 150. It's too early to say if this is happening, but I would urge you to keep an eye on such a possibility." And that's the end of the quote. That possibility looked real until 17 weeks ago, when the market dropped down and below what I thought might be the lower bullish trend line, highlighted in dark blue. The market only dropped below this trend line, and let's be honest, it was or is an unjustified trend line, but went on further to drop and close below the gold long moving average, which is currently 108 3/4, stabilizing further down, dropping and closing below a new support line. That's the bright red neckline, currently at 97 3/4, of a new simpler pattern which the market opted to utilize instead of the more complex diamond pattern. became a February to early October head and shoulders top, 2025 head and shoulders top. The issue I had and still have with this pattern is that we are now past the early stages and we really haven't confirmed a move either higher above the gold long moving average or lower, sufficiently below the bright red neckline extension. I chose 13 weeks ago to lay out some potentials below for such a head and shoulders top pattern, just in case. Thus the primary target X is down in the 70 even zone, with a secondary harder to reach target X1 down at 43 3/4. You'll easily note that the primary target X is at the lower end of the congestion seen between September 24 to January 2025, between approximately 70 to 85. Since then, nothing, or at least nothing much has occurred. We even had a weekly key reversal up 9 weeks ago, which failed to follow through, and instead ended up the following week with a combination of a hammer pattern, that's usually seen as a bullish pattern, though not always, and also a week 2 and a 2-week descending hawk pattern, a bearish pattern. Thus, contradicting patterns, and quite a few of them as well. It all still comes down to what I said 13 weeks ago, and I quote, "Only concerted, consistent and long-term moves over the new bright red neckline, and ideally over the slowly rising long moving average, would possibly assuage the bearish potential, at least as far down as the 70 to 85 congestion." End of quote. We have been half there and half not there, and the last 9 weeks moves just exemplifies these half in and half out contradictory courses of actions. It is indecision, but on a much, much larger scale, more than just a weekly chart can really show.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.